All right. So good evening, everybody. Welcome once again. Who is here, please? Sadia Alimotu. Sadia, good evening. How are you? You are welcome. ABU? ABU. Sadia. Hello, Sadia. How are you? Austin Como. Austin, you're welcome. Big E.
Good evening, sir.
Yeah, Austin, how are you?
Very well, thank you, sir.
How was the day? Good?
Bless God, yes, sir.
Is it still cold over there?
Yeah, a little bit.
All right. ABU Alimotu. Alimotu Sadi, how are you?
I'm good. Good evening.
You're welcome. This is your first time coming here? Is this your first time?
At this
Sadi?
time.
Huh?
Yes.
All right. So,
yes, at this time, but I usually attend in the morning.
Oh, all right. So you're welcome. Ms. Chinyere, you're welcome. Clara,
Thank
welcome.
you.
Who is an iPhone? iPhone, is it Mary? I don't think so. Maria, how are you? I'm Precious. Say, you're welcome. All right.
I'm good. Thank you. How are you?
Who's on iPhone? iPhone.
No, not me. Mm-mm.
Who's on iPhone? Is this Mary?
No, must be.
The person.
Marie. That's me right here.
Oh, better. Is it better? All right. So, better. Oh, better. The one that want to steal my name. So, Miss Beta, how are you? All right. So, we're gonna go along to start from where we stopped in the morning, which is annuity. Annuity. We all already know what annuity is. From the beginning, we were able to define annuity. We said annuity is a blend of insurance and investment features. It has blend of insurance investment features. So in this particular chapter 9, we see us talking about investment always. But when we are dealing with life insurance policies, you never see us talk about investment because we know life insurance is not an investment. Yep, it's not an investment. Although it has element of savings, but however, it's not an investment. So anybody who takes a life insurance investment, that person is lying. Most people will go and have a policy they thought they have invested. It's not an investment. Whatever that come out of it is the benefit thereof, which you equally put it in. So life insurance is not an investment. It's not an investment. It's a protection portfolio. So, but for you to happily retire well, you have to have an investment portfolio and protection portfolio. Does life insurance have element of protection portfolio that can accumulate and make some gain out of it? Of course, yes, but it's not an investment. You can see purely that what we're discussing in annuity is purely about investment. You can see it's purely about investment because what? It does not involve death benefits. It does not involve death benefits. And more especially because life insurance is a risk that's being shielded by the insurance company. The insurance company bears the risk. So based on that, you do not discuss it to be an investment. But in annuity, you are the policy owner. You are the policy owner. You bear what? The risk. So that's why, because if you say you're investing, if you invest in anything, you must bear the risk. So that's why life insurance is regarded as not as a protection portfolio and not an investment portfolio. Then we say is always act as a bridge, that bridge between the gap between the savings you have accumulated over time and what the return of income, retirement income, the bridge between the savings you made and the retirement income. That's what annuity is. And we also said annuity use long-term retirement savings. Of course, it acts like both an insurance product and a guaranteed income product. So, and if as an investment product, it will grow, it have a potential to make a growth in terms of it's like whatever you put on it must have to grow. We talked about the fixed annuity, which we said behave more like an insurance, and the variable annuity, which we said behave more like a registered security investment. Because it offers a tax-deferred growth and protection from market and protects us from market volatility. We equally go ahead to talk about annuity key benefits, which we say have 3 key benefits. One of the benefits is the benefit of tax-deferred growth. Of course, if you invest in annuity, the principal, when during the accumulation phase, the principal, you add the principal, which is the funding. Then during the amortization phase, which is the payout phase, then you now expect to have the principal plus an interest. So there's a tax-deferred growth. So in that principle, when the amortization phase or the payout phase, you're gonna take the principal plus the interest. Then the interest is taxed. The principal will not be taxed depending on the funding. If the principal comes from after-tax money or funding, then you're not going to pay tax again because you already paid tax on it. That is what I mean is that if you go to your bank to withdraw money to fund your annuity project, then the principal will not be taxed because it's an after-tax money. You have already paid the tax. But if you roll over your 401k to annuity, which you have not paid tax on before, what happened? During withdrawal, you're going to pay tax on the both the principal and the interest. That's what, because of that, we say it's tax deferred. So annuity has another benefit of being able to provide income for life. It provide a very reliable stream of income for life. If you invest on annuity and choose an option that can give you income for life, yes, it's possible, 100% possible. Now we talk about another benefit again is the market protection. Of course, it protects you since it's fixed and index. It has a fixed and index option. Because of that, it protects you against losses. Of course, that's why we generally say annuity liquidate asset and life insurance do what? What does life insurance did? Who can remember? We have 2 ways to differentiate. In fact, the main difference between annuity and life insurance. We say annuity is an opposite of life insurance. What are the one way that we know? We said life insurance do what and the annuity do what?
Life insurance create estate and annuity liquidated.
Yeah, annuity liquidated. Please remember that you may see it in the exam. I always want to say it anytime so that it can enter all of us head. So what the most critical thing and the most important thing to me, I feel life annuity does is that it gives us this protection against losses. You investing in something and participating only in the gain give you an edge over any other person, which means if there is any loss, it's not your problem. Yeah, because your attention is to make a gain. And you only participate in the gain, which means if the loss is occurring, it doesn't concern you. You don't participate in the loss. You participate only in the gain. So that's what annuity does. So we're going to go now to start from where we stop in the morning, where we stop in the morning. And we were able to say different types of annuity. We talk about the 2 principal things that happen in annuity, which is the amortization and accumulation. The accumulation phase, the 2 phases in annuity, the amortization phase and the accumulation phase. The accumulation phase is that phase in which you pay in money to your annuity. Then annuitization phase is the stage in which you begin to get money from the, get proceeds from the annuity. We call it the accumulation phase is the paying phase, and the annuitization phase is the payout phase. And the annuitization cannot start until accumulation stops. So that's exactly all that we have been discussing in today in annuity. So let's go back to where we stopped in the morning. If we see anything that's not understood, we can equally say something about it. Except anybody have some questions, we can try to see whether I can answer it before we go. I'm gonna say this for people who are not here. We have 5 ways you can classify annuity. You can classify annuity based on how the premium are paid. Annuity can be classified as regards how premium are paid. You can pay a single premium. That's one-time lump sum payment. You can do a flexible premium, which means multiple payments over time. That is classification based on how annuity can be funded. The second classification of annuity is classification based on when benefit begins. What is benefit? When amortization begins. So you can do immediate annuity, which means payout begins shortly after purchase, which is after accumulation. I mean, definitely in the immediate annuity, there's not like accumulation. However, what you see there is that you pay one time. It's one-time premium payment, lump sum payment. You pay lump sum payment, the accumulation phase has stopped. Then what we'll be looking at now is the amortization phase, of which the amortization phase of immediate annuity can start 30 days to 1 year. But however, when it starts from the 30 days to 60 days, you may not see any principal, may not see any interest. What you'll be amortizing is only the principal. There'll be no interest. But from this 90th days, which is almost 3 months, you begin to see principal attached to the, you begin to see interest attached to the principal.
Interest attached to the
Interest
principal.
attached to the principal. So there's one of some of the things you have to know. Now, we have equally deferred annuity. Deferred annuity will say the payment begins at a future date. Most often, people do deferred annuity. The one you can put your fund, you put your premium today, you say, all right, I will begin the amortization we start maybe in 10 years' time, in 5 years' time, in 15 years' time. That is deferred annuity. The another source of classification based on source of income. How do the income come in? One, fixed annuity, which we say is guaranteed payout. Variable annuity payment vary based on what investment performance. Index annuity linked to a market index. Another classification is classification based on disposition of proceed. How are the proceeds being distributed? You can do life annuity, which can give you income for life. Payment continue for the annuitant lifetime. Then we do period certain, which is payment for a fixed period. And return option, which means remaining value paid to the beneficiary. Period certain payment for a fixed period means that when you pay, as an annuitant, you'll be collecting the money. If the contract owner dies, then no more. The remaining money will go to the insurance company. So we have the refund option. Refund option, the disposition proceed is that the annuitant will be collecting the money. If the contract owner dies, the remaining one will go to the beneficiary. The last classification is based on the number of lives covered. Of course, it can be single life, which is one annuitant. It can be joint life, which is 2 or more annuitants. Then what I want everybody again to remind people, we have done all this, I just want to recap. Some other thing I want everybody to know is this. In annuity, we have the contract owner. We have the insurance company. We have the contract owner. Let me not call it insurance company, the insurer. Now we have the contract owner. We have the annuitant, and we have the beneficiary. The contract owner is the owner of the contract, the owner of the annuity. The person who did the annuity is the contract owner. Then the annuitant is that person whose only function is to get the proceeds, to collect the proceeds. Then the beneficiary is that person who is standby. If the contract owner dies, he will get the benefits. Then people get confused when you say here annuitant. Annuitant is that person appointed by the contract owner to collect the proceed or the benefit that comes from out of the money invested. However, the contract owner can be the annuitant, or he can appoint any person to collect the money. So the beneficiary in annuity only come in when the contract owner dies. If the contract owner dies, does the annuitant has anything to do? No. The beneficiary will step in to get the benefit. So that's all that we discuss. We can't start all of them beginning. I just do the important ones. So we talk about the level premium annuity. All those we have talked about them. I think we have to go to where we, otherwise we're gonna waste a lot of time. Let's go to where we stop. I have done a bit of recap for those who did not start with us. Straight life annuity, we talked about this one today. Annuity period certain, and life annuity with period certain. Life with refund option. Classification according to number of lives. We've done it. Additional annuity characteristics. Guarantee minimum withdrawal benefits. This is where we are. This is where we stop in the morning. I think I'm right. So the only
Yes.
way to get annuity is please get a piece of paper. Normally the instruction we have in this review, just like I said, everybody here can do this thing and pass this exam without anybody. That's the truth. Nobody, most of people here are doctors, professors, so which means everybody can read it and pass on his own without even coming to waste time here. But the reason why we come together like this is to share ideas. Sharing ideas means that nobody, I'm just a moderator, nobody's teaching anybody, because all of us here are professionals on our own field. But because we don't have time, because we are preoccupied with some other things, and now decide that, oh, we're going to pass this exam, of course, let us know what's going on within ourselves and within our family. It's the best place to be. Let me tell you the truth. Even if you cannot do the business, I'm saying it with all understanding, based on what I've seen. Even if you don't want to do the business, please, for God's sake, get this knowledge. It's very, very helpful. Do you know today, I have to call my mortgage company. Oh, God. When you go with time, you begin to discover things that these people are ripping us off. I have to call my mortgage company today. Say, look, I want to remove my escrow account from my mortgage. Because I did some analysis. I found out these people, in as much as you are paying the escrow on their mortgage, they are charging you for that services. So all this is experiences and the knowledge you have to get from here, so that you'll be checkmating all those wastes. The wastes we are encountering are too much. The wastes are too much. So please, being here is a good thing. It's not a waste of time. In a sense, in as much as we can pass the exam by ourselves, but still coming together to share knowledge is the best. Because what we discuss is always with you. Even if you enter hall, you will see that if you wanted to write the exam, enter the exam hall, you see that what will be seen in the exam hall will be as if what we are discussing here. And honestly, for those who have passed the exam, when they come back, they'll tell you that, look, it's like I'm hearing what we are discussing, what we are seeing in the exam. So it's not a waste of time you coming here, in as much as you can read it by yourself, but it's still good to share ideas with others. And that's why in the group, you see that they say everybody should be on camera. The essence of that is to make people get committed. It's not forcing anybody. Nobody wants to see anybody's face. But however, it's just to avoid distractions, so that you be committed. Because if you're on camera, you don't want to do one or two things so that anytime you come and sit down, you know that you are in. For that 2 hours, you share knowledge and you log out. So that is it. So please, I want everybody, no matter how professional you are, just get a piece of paper. There are some things you can jot down 2 days or a day before the exam. Just go through those jotter and you get it, you remember it. So please, who is the Zoom user? Who is Zoom user? You don't have a name? Let's know whether we have some FBI people here. Who is Zoom user?
That's Mary.
Oh, Mary. All right, Mary, you're welcome.
Thank you.
Yep. All right, so let's go. Kingdom Ezenwa. Ezenwa, you're welcome. Mr. Ezenwa.
Good evening, sir.
My brother, you're welcome. You're welcome.
Thank you. Yes,
Yeah.
I'm joining you for the first time, but I get all the invites, but mostly I'm at work when
Yes, I know. Oh, you live in California?
No, I live in Dallas.
Oh, Dallas. Dallas here.
Yeah, Oak Cliff here.
Oh, what are you talking? So we will see you in Champion Ball, February 5th to 7th.
Yes, I got an invitation. I'll be there. Thank you for the invite.
Please come and just see what's happening in the country that you are in, that you don't know that is happening.
I will be there.
Honestly, just come and witness. Come and see it. You ask yourself, where have I been in this Dallas? Now, this is happening every year, once every year, and I'm not there.
Yeah, that's what I told Miss Ola that gave me the invite. And after I listened to the first conference introduction, I said, why didn't you tell me this all these years? I've been here now 25 years.
When you come to Dallas, when you come on Champion Ball in Plano Event Center, you come there the first day, you ask yourself, where have I been? Where have I been?
And the funny part is that I sat for life insurance license in 2007 and passed it, and tried to work with it for a time, and I almost lost my house. I had to go get a job. and that elapsed.
Imagine if you have put time, people don't have patience. If you have put time on it, imagine where we would have been now.
Yeah, but anyway, I think then it was different from.
No, it's not different. It's the same.
The presentation that I saw.
Yeah, it's just the presentation.
The financial aspect of it wasn't explained to me at that point.
All right, yeah, right.
It was just about selling insurance, health insurance, and
Yes.
If you have a family to feed and then money is not coming, But anyway,
it happens to everybody.
Working, but almost close to retirement, so I'm determined to do this now.
No, it's good. No time is waste. The thing, anytime you're doing to do it to your own even people who retire, who have retired, this is the best place for them to retire.
Oh yeah. Okay.
No, I tell you the truth. Then for younger ones, they have it. But for those who are about to retire, this is the best place to retire.
Yeah.
You retire, you still be very active and still making your money and still touring the whole world.
Yeah.
And the most important part of retirement is retirement with happiness.
Yeah, that's right.
So thank you for being here.
Thank you for inviting me.
All right. So let's go ahead. So this morning we stop at guaranteed minimum withdrawal benefits. We have done all those classifications. Why I recounted the classification is to bring to fold everybody, to take everybody's understanding back to where we started from. That is the initial point. I always say this classification is the basis of understanding annuity. When you understand the classification, honestly, you grab it, you don't lose it again. Those 5 classifications, they are the basis. They are the foundation of understanding this annuity. Remember, annuity is a section of life insurance discussion. And annuity is on the side of life insurance. We say is always almost opposite of life insurance. Because if life insurance can create estate, then annuity liquefied it. It means that this one work for this one and this one work for this one. But however, for you to retire freely, happily, you should have a protection portfolio under retirement portfolio. What investment portfolio? What is that? Annuity. Annuity. This is the only portfolio that you can only gain, you will not lose. But most times, due to we don't have that vast knowledge to understand what it really means, and people overlook it. Most of people even don't know that annuity exists. Most people who have worked several places, they still keep their money in 401k. Yeah, they still, in fact, they go as far as rolling their money. If they're working in company A, they leave company A to go to company B. If company B is having 401k, they roll over the money they have accumulated in company A to company B. You can see that knowledge. And those people who sit, the managers of your account in the annuity will be laughing. So I'm making money. If you get a toothpick, I know everybody knows what's toothpick. Whenever you roll such money, they will get their toothpick, put in their mouth, they'll be laughing at you. They'll be laughing at you. And when you call them, the seriousness, the way they will be speaking to you as if they're helping you, rather they are ripping you off, not helping you. Imagine you paying for somebody for managing your account. Does it make sense? You pay somebody, whether you are losing, you are gaining, you're paying somebody to manage your accounts. And upon that, if you call him or her for some information, he'll be doing as if he's giving you favor, not knowing that you are paying him his salary.
Can I ask a question?
Go ahead.
So with this, can you manage your own 401k?
You don't need to manage any 401k. You manage your you manage your account. You cannot manage your 401k. When you
Okay.
roll over 401k where you have been working before,
Mhm.
any company have worked before,
Yes.
that have 401k,
Yes.
just roll it over to annuity where you can manage it by yourself.
Okay, because I rolled mine over to IRA, but anyway,
If you
that's one of the reasons why I'm more interested in this, because
if you roll over to IRA, you are still keeping it in a volatile market where you're
Yeah.
suspect to loss. But
yes.
if you bring it to annuity, you do not participate in the loss, you only participate in the gain, which means your money is safe. However, the withdrawal portfolio still exists when you roll it over, roll it over to annuity, because the money is whatever you're rolling over is still pre-tax. It's not after
Okay,
tax.
so you don't pay tax by withdrawing it, putting it in annuity.
No. You pay tax. What I mean, is two kinds of funding, depending on funding. If the money you are funding to annuity is after tax money,
Okay.
which is, let's assume, Roth, is
Yeah.
after tax. If you're rolling Roth over to annuity, when you want to withdraw, you're gonna pay tax on the interest.
Okay.
But the principal, you're not gonna pay tax because you already pay tax on it. So if you
Okay.
go to your bank and withdraw money and put into annuity, during the amortization phase, which is the withdrawal phase or the payout phase, you're only going to pay tax on the interest. But however, what we are saying and why it's much important is that in that instant of annuity, you only gain. You do not lose, because you operate in fixed index. The compounding effect is better than compared to any other portfolio. More especially in 401k, where if the weather sneeze, you lose. The how much your money is there is today may not be how much you be tomorrow morning. That's essence of 401k. But in annuity, you do not think about losing, you only think about gaining. Yep. So, but if you shift your money from, let's say, roll it over from 401k to annuity, yes, the money from annuity, from 401k, it's pre-tax. You have not paid the tax, which means it still holds. The withdrawal penalty still holds. But the good thing about it is this: you don't lose again. And the interest thereof will be higher than what you are seeing in 401k.
So I know I'm sorry if I'm
No, go ahead. We are discussing.
taking everybody outside of this, because I'm
No,
interested
we are
in this.
discussing. Go ahead.
That's one of the reasons why I'm interested in this part, is because can somebody withdraw the money he has in 401k or whatever? I work for the government, so they call it TSP.
TSP, yeah. TSP,
Yes.
yeah. Mm-hmm.
Can you withdraw your retirement saving and put it in this annuity?
All right. If TSP, you can roll over, or we don't talking withdrawal.
Roll over.
But you will not roll over in your present job where you're still making a contribution.
Okay.
You will not roll over. You only roll over in your previous job, a job you're no longer working on.
Okay.
I retired November. I retired, and the first thing I did was to roll over my 403B to annuity.
Okay.
Does that affect my retirement benefit? No. My retirement benefit is still with that company. Of course, that one, nothing happens to it.
Mm-hmm.
The effect of interest or that does not affect the retirement benefit. It's there for you. Then the annuity, the 401k, which is the one you contribute,
Mm-hmm.
or maybe either contributory or not contributory, depending on how your company do
Yeah, the match.
So the match. So that one, you can roll it over where you're no longer working. Or if you get out from the job, or you retire from the job, or if somebody is sacked and that person has contributed enough there, you can roll it over to annuity. Yeah.
All right. Another question. What if you have an IRA? Can you move your IRA to annuity?
Of course you can. I have a Roth. You have traditional IRA or a Roth. Which one do you have?
I think it's traditional.
Traditional.
I don't know the difference anyway.
All right. There's traditional. There's non-traditional. All of them are the same. Is after tax though. So you can roll it over. I did mine. I have to because what I did when I was working, at the point I did it about 4 or 5 years ago. When I entered this business, that's when I know about this. So what I did was to go to my account, put part of them to Roth. Some of them is still going to 401k. So now that I retired, I now have 2 accounts. One of 401k, the other one is Roth.
The same thing with me. I have one IRA and one
Yes, that's good. Yeah. So what I did was to do what? I roll over 401k in different account. I roll over Roth in different accounts. So in that account of 401k, I don't have any money on there again. I roll all of them straight over to annuity, but in different accounts. So in that case, what you're going to have is 2 annuity because this one is after tax, this one is pre-tax.
Okay.
Yeah.
I will explore that as I go on. So, but I'm interested.
Listen, you guys, please, let's move. Yeah, let's move.
No
Later you can talk about your account. Let's move.
All right. So, let's go. Let's talk about the guaranteed minimum withdrawal benefit. Of course, is a rider. What I want you to know, even in life insurance contract, in annuity contract, you always have a rider. But remember, rider doesn't come free. It's something you pay. And if you pay in for a rider, you have a lot of benefits. Or otherwise, you can just do your annuity and go, or you can just do your life insurance and go. It's not the same when you have a rider and somebody who doesn't have a rider. The only difference is that the person who have a rider may pay more on premium than somebody who doesn't have a rider. If you don't have a rider, you are paying the standard, but you have a rider, you pay a little bit more on the premium. And what does riders do? Riders give you more benefit in the contract. So guaranteed minimum withdrawal benefit is a rider. It's a rider that may be included in a variable annuity contract. What does it do? It's guarantee the policyholder, who is the contract owner, a steady stream of retirement income regardless of market volatility. So if you put this rider on your annuity, it's going to give you this increased steady stream of retirement income, regardless of what is happening in the market. Whether the market is tumbling or not, you're going to still benefit. So during market of downtown, that's when the market is down, the annuitants can do what? Withdraw a fixed percentage of their entire annuity investment. Annual maximum withdrawal percentage vary by contract, but are generally between 5% to 10% of initial investment. So if you find out the economy is so bad, but how, I don't even know when the economy is so bad to that extent that then the market now can be so much that you begin to go and touch your annuity. So if such a thing occurs, you can go and get your principal just to avoid market volatility. So to avoid maybe losing. Of course, definitely, you've not reached that. The only portfolio in America that guarantees safety net is life insurance policy and annuity contract. That's only. Remember, in your banking, you go and put money in a bank, you have of 300,000. If the bank had problem, by law, they will give you what? They pay you $250,000. That is the maximum you can get. But because banks put their money in life insurance, government money is in life insurance, insurance company. What happened? Insurance companies have the most protected tools. Of course, that's why no matter how your estate is, the person does not have any beneficiary. Nobody goes to your life insurance policy except there is no beneficiary to collect it. If there's no beneficiary, the insurance company will now send it over to your estate for government to go through your estate. And probably, since there's no beneficiary, the government will take the proceeds. So, guaranteed minimum withdrawal benefit is what? A rider, which you can put to increase your benefit in annuity. Of course, because it guarantees you steady stream of retirement income, regardless of whether the market is tumbling or the market is not tumbling. So that is guaranteed minimum withdrawal benefits is a rider. Then guaranteed minimum income benefit. This one is another one that everybody want to get. It guaranteed minimum income benefit, guarantee a minimum income amount at amortization. Remember, the amortization we are talking about is when the payout starts. Accumulation is the pay-in period, which is the time you fund the annuity. The amortization is the payout phase, which means the time you begin to withdraw your proceed. What is that proceed? Is the principal, the money you put in the annuity, and the accumulation that come out of it, which is what the interest. So therefore, you can only be taxed on the interest and not the principal, depending on the source of funding. Depending on source of funding, sorry. So this one guarantees minimum amount of amortization, regardless of market performance. The payout is based on the greater of two values: the account actual value or the guaranteed minimum income benefit base. So these are the two ones. Let's go to guaranteed minimum accumulation benefits. What does this one do? It guarantees that the owner's premium paid into the contract will have a minimum accumulation value after a set waiting period. Of course, most people does this. One of the annuity ideas is guaranteed minimum accumulation benefit, which means you have to choose a certain period whereby the accumulation stop, the investment has to save for some time before you go for amortization. You have to do that. So most people always like to do that. The long-term care riders. So you remember what we said in the life insurance discussion. You can have a long-term care as a rider in life insurance. You can equally have it as a single policy. So in annuity, you can still have a long-term care rider in your annuity policy. But remember, it does not come free. It does not come free. You have to pay. So what does this one do? It allows the payment of a percentage of the death benefit if an individual requires long-term care but is not terminally ill. So if the person is not terminally ill, but however, the person is in the condition that he needs long-term care, then that's when long-term care riders will come in annuity. So as we have long-term care rider in life insurance, we equally have it in what? In annuity. Remember, in annuity, the long-term care rider sometimes can be added to you free. If you don't have chronic rider, then they can give you long-term care rider. But however, if you don't have any, you can equally go and buy it as you buy another policy. So long-term care can be bought as a single policy. In fact, most people like to do it. These are just summary of what we did. All right, qualified versus non-qualified annuity. As we have qualified account and non-qualified account. So can anybody remember what is qualified account? Let's start from there. And non-qualified accounts. Of course, that one is so easy. What's the qualified account? Somebody should help us. What is the qualified account? We have said a lot of it.
Eh?
What is a qualified account? Can anybody help us?
Don't remember hearing it.
Qualified accounts?
Qualified account are those accounts like 401k, you have not paid any tax on it. Then the non-qualified is the one that you have already paid tax, like your check.
Like Roth?
Yeah. So she is correct. Just qualified accounts are the pre-tax money.
That's why. Oh, I was talking all
Then-
along. My mic is mute.
Then the non-qualified account are the after-tax money. Just get it that way.
So after tax is like a Roth?
Roths, yes, they are after-tax money. They are non-qualified accounts. But the qualified account is 401k, 403b, TSA, all of them are qualified accounts. They are pre-tax money. So during withdrawal, you're going to pay tax on them. And they tax you as an ordinary income. So therefore, you can see that the 401k, everybody is bragging of. You don't even guarantee that when you want to withdraw and when you retire, there'll be money there. Because Uncle Sam have to pay himself first before you. That's the truth. So depending, I think everybody here knows that tax will be higher in the next future than now. Everybody here knows that. That tax will be more tomorrow than it is today. In fact, I would say today tax is on sale. Tomorrow, the tax will increase. Check out if some of you that have mortgages, check out how the tax increase, the effect it has on your mortgage. Just check out. So that's why today I talked with my mortgage people. They were like, because they don't want it to happen. I told them that, look, I'm going to remove escrow from that account. They said, what? Why? I said, just because I want. Say, is there any reason? I said, no reason. The only reason is best known to me, and I want to remove it. So they're going to
Your
send
money
me.
talks. If you have your money, put your mouth where your
That's
money
right.
is.
Yeah, they said they're going to send me email. They're going to send some papers that I will sign. I say, yes. When is it signed? When are you going to send it? They said they're going to mail it out today. I said, thank you. God bless you.
Just so.
Someone, I told one of my friends what he do and call his own mortgage, the own mortgage. Say if you want to remove it, he's gonna pay penalty. My friend called me back. I said, tell them how much is the penalty. It's 300 something. I said, tell them that you pay. We are learning. We're gonna learn. We're gonna deal with them one by one.
Of course, and I'm gonna learn from
all
you.
those loopholes, we're gonna block it.
All right, Nigerian man.
We're gonna block all those loopholes. This is the beginning.
Yes, brother.
By the time we get to our children, they will
Yes,
follow us.
yes.
They're gonna
They're
deal
in
with them because
control.
they will not get all those small money that are getting to
Yes.
go to golf and be playing golf while you are working. No.
Yes, that's true. Yes, my brother.
Mm.
That's what we're working
We're
towards.
gonna learn and we're gonna all those loopholes. We're gonna close it. So let's talk about the qualified and non-qualified account. We have agreed that qualified account is a pre-tax, and the non-qualified account is after tax. Pre-tax is account like 401k, 403b, and TSA. Then non-qualified is to talk about the Roths, traditional and non-traditional Roths. So that's the non-qualified. So in as much as we deal with those in our life insurance, we're going to do it again in annuity. The qualified versus non-qualified annuities. So with a non-qualified annuity, the contributions are made with after-tax dollars. Non-qualified. It's just the same thing with what we already know. The non-qualified is after tax. Qualified is pre-tax, before tax. So contract owner receive the tax deferral of interest and growth earned, but there is no tax deduction of premium or yearly tax saving through a salary deduction. So in essence, just like Ezenwa is saying, he has TSA and he has ROT and he has TSA, the men's TSA. So what it means now is that if he want to roll over his money to annuity, the TSA is the qualified account. The ROT he has is the what non-qualified account he has. So in the annuity, the TSA becomes now the qualified account for the ROT, and the ROT he has become the non-qualified account in the annuity. So that's basically what it is. And based on that, when he want to withdraw his money, maybe after 10 years or 15 years, depending on the duration period he wants, when he want to withdraw the money, the qualified account, which is a TSA, he will pay tax on the principal and the interest because those are pre-tax money. But the one on the non-qualified, which is the ROT he has, he will only pay interest on the interest. I mean, he will only pay tax on the interest. He's not going to pay tax on the principal because he already paid tax on the principal when he's still as ROT. So he's no longer going to pay tax on the principal. He will only pay tax on the interest. So that's the difference between the two. So as it happens, it is in insurance or in health insurance. That's so as it is in annuity. It's the same tax deduction. Qualified and non-qualified is the same thing. So if you know it in that place, you already know it here. The same thing applies.
I have a question for you.
Go ahead.
If you have a ROT account, but you want to put it in annuity, is it compulsory that you have to put it on the account? What is that? I think I lost my train of thought.
Oh, you're talking about annuity. Is it compulsory to put it in annuity?
So yes, if you have to put it in annuity, does it have to be in a? That's a way I wanted to express it, but I think I lost my train of thought.
Is it what you're saying is this? If you have money in the ROT, is it compulsory that you can put it on annuity?
Is it compulsory that you put it on the non-qualified account?
Of course. See, it's not compulsory, but it's there already. So there's no compulsory there because it's a ROT. So it's not qualified. It's already non-qualified. Okay. For the fact that it's ROT wherever the money is a ROT, it's already non-qualified. So
I can bring it and say I want to put it in index annuity.
You can. That's what I'm telling you. For the fact that that account is ROT, the account is ROT. It's non-qualified. ROT is non-qualified. So if it's non-qualified, you are rolling it over to annuity. You roll it over as a non-qualified account. So what it means, during the time of withdrawal, when you want to withdraw it, you're not going to pay tax again on the principal, but you pay tax on the
interest.
Yes. So ROT account is also can be regarded as a non-qualified account. Okay. Another name for it is non-qualified account. Let me put it that way.
So okay. let me ask another question. So now, suppose you have it in a qualified account, and you want to put it in qualified. Do you have to pay tax as you withdraw it and transfer it?
He said, ask a question again.
Okay, so I'm still new, so
go ahead.
Let me use the ordinary word. So I have it in, say, TSP, and I know I haven't paid my tax because it's pre-tax.
It's pre-tax, yes.
But I want to take it out there because this other one gives me more interest and more stable indexed. Do I withdraw it, pay the tax, and then put that principal, whatever I left in this indexed annuity?
All right.
I don't know what I'm making sense, but you know.
I understand what you're saying, but
Yeah.
however, the truth of the matter is this is your money, and we do not advise people on that basis. So is when you get the knowledge, you do whatever I think that is good for you.
Okay.
Yeah, we are alive, so we do not advise people to pull your money out from, more especially where the money is still accumulating. No, you cannot pull out money from where it's accumulating.
But
However,
if I will get more unstable, you know, like indexed annuity, and it's better for me, I'd rather pay the tax now and just put my
is your personal decision.
Okay.
If we get the knowledge, it's your personal decision. I told you today, I called my mortgage company that should remove my mortgage from remove escrow from the
I
mortgage.
get you. Yeah.
So it's a personal decision. It's a personal decision. Yeah. So all right. Any other question before I go ahead? All right. So let's look at here. I highlighted. It's a qualified annuity is one that purchases as part of tax qualified retirement plan. If the premium paid for a qualified annuity is in the form of contribution by an employer to a qualified retirement plan, the premium is tax deductible to the employer. Some qualified annuity also permit employee to fund the plan through a salary reduction, that is a tax sheltered annuity or TSA. Tax sheltered annuity or TSA. So what they do in a TSA is what the employer funds the plan through a salary reduction. That's what they do on a TSA. So in this case, what the plan was funded with pre-tax dollar. So you do not want them to, most times, if it's possible to convert all the account to Roth, if your company allows that, so that let them take their tax now. I think it's good if you can do that.
That's what I'm saying.
No, you can talk with your company. If they allow you
I know
to
that I've
transfer
paid my
all the
tax,
accounts.
and then whatever is left there, I know is solid and reliable.
All right. Look at you did. I did mine. I know in there when I was working, I take part of the money goes to Roth, and part of them goes to 403B. You understand? That's what I did. So somebody can decide if it's possible. You're gonna ask them if it's possible. If you want, if your own decision is that, oh, can you all this money come as a Roth instead of TSA? Yeah, if they allow you to do that, you can do that. So, which means you want to pay tax now instead of tomorrow. Yeah, you can do that. You can ask them if it's possible. Some of them may not allow you by their own rule. But if it's possible to allow you, you can do that. Yeah, you can do that. So that you have known that, or at least you have paid your tax today. Not about paying tax tomorrow. Yeah. Ask them if it's possible. Some they will not allow you. I know mine, they did not allow. So what I did was I have it. This one goes to this side, this one goes to this side. So ask them. That's the question. It's the high time you begin to ask them questions in your job. Some of these intelligent questions to pay, so that you ask them, they will give you answers. Based on the answers they give you, you now turn around your brain and say, is this true or not true? If it's not true, fight again.
Just chill until you get all your ammunition. Then you go. Okay?
All right,
Don't
doctor.
go now.
All right, doctor.
So let's say individuals' uses of annuity. How do you use annuity? At least all of us here have known that annuity bring a stream of income for life. That's one of the uses, which all of us knows. So any other uses now become personal. Of course, you are writing policy. You're not just writing the policy because you want to write policy. Even life insurance, you don't just write life insurance policy because you want to write policy. No. You have to have something in mind. This policy, what effect is going to have? Based on your needs, based on your family and personal needs. That's how you write policies. If you're writing, let's assume you're writing life insurance policy, you first of all say, all right, am I going to base this policy to accumulate for accumulation? Or am I going to base this policy for me to protect me? That's the question I ask yourself. Then you go for annuity. It's all right. Am I going to take risk? Because remember, in life insurance, the insurance company bear all the risk. But in annuity, you are the contract owner, you bear the risk. So if you're writing life insurance policy, based on your needs and family needs, design your policy that will suit your needs. Then if you're writing annuity, design the policy to suit your needs. You can see when we talk about the withdraw, the payout phase. You know, we have a lot of the distribution. You know, we have a lot of distribution types. So those are the decisions you have to make. But you only make those decisions if you know. If you don't know, you're not gonna make it. The agent will make it for you. So sometimes somebody will say, I know Dr. Ruth, my wife will always tell people, say, look, what you do is that come and know the law that governs what you have. That's why she always like to make that comment. Because if you know what annuity is, I did my own. I did 2 annuity about 2 weeks ago. Or in fact, I completed it last week. Because I now know, because I understand it. So what I did was now say, all right, I need this one to go this way, and then this one for this way. And because I know it. But if I don't know, who will make the decision for me? The agent. Whether the decision is good, it will make the decision for you. Whether it's bad, he has made it for you. But if you know, you'll do it and do it to your own benefit. So for some of you that have an annuity, you can do the annuity by yourself. When you pass and get your license, you can do it by yourself. You can
Do you
design.
have a limit of the number of annuity account you can have?
No, there's no limit. There's just like life insurance, there's no limit. You can have annuity in all the insurance companies. I mean, life annuity companies. Nobody questions you as far as it's their money. If you win lottery tomorrow, win 100 million tomorrow, you can decide to share it to a different.
And you say 10,000 is the least amount?
Yeah, most of the companies say 10,000. Yeah. Yeah. So you do annuity is something you can do. Is it the good thing about it? You get your license. You want to write your own annuity. When you write it finish, they will pay you commission for writing it. That commission they pay the agent, they pay to you. You can see that is good. Mine, we just finished writing that my daughter has submitted. They're gonna pay my daughter the commission. So if I write it for myself too, they'll pay me that. So you be an agent, learn it. Now that you're learning annuity, you can do it for yourself and still get paid for doing it. But however, sometimes it's good to do fast and so that to bypass things that are ugly. So in order to not to waste time, you can tell the person who brought you to the business, to say, look, I want to write my annuity. Let's do my annuity fast. That can be happen.
Do you have limit on the amount you can write for yourself, the amount of annuity?
No and yes.
Huh?
No and yes. No, in the sense there is no restriction of amount you can write for yourself, unlike the life insurance. Yes, it is based on what? Your assets versus your debt.
Yes.
Yes. What your asset versus your expense is the asset versus the expense.
Yeah.
For instance, you're gonna write out all the assets you have, including the life insurance policies, their asset. So remember, you can use life insurance as a collateral. I hope everybody knows. You can use it as a collateral. So when you're writing annuity, and the life insurance policy is an asset. Your house is an asset. The amount, how much you're going to pay on that house now compared to how much you are owing. How much you are owing becomes your debt. How much you can sell the house becomes your asset. Your car is one of your assets. If you're owing on the car, the amount that remaining is what? The debt. So they're going to bring all those and compile together. When they compile together, they now subtract the asset from the debt. Then if the asset is big enough, more than the debt, then you said you have passed what we call suitability test. So based on that, immediately on the is past suitability test, you can now invest any amount you like to your annuity. You're no longer restricted. You're no longer restricted. But however, you have to pass suitability test before that. Is that okay?
Yes, thank you.
All right. So let's go to qualified annuity plans. Qualified. Everybody knows what non-qualified is. Non-qualified
Yes.
is what? Account that is an after-tax account. The qualified account is what? Pre-tax account, which is like 401k, 403b, TSA, or any all of them. They are qualified account. So although retirement plans are covered in details in later chapters, we have talked about retirement plan well since beginning of this. So as mentioned above, annuity may be used to fund qualified retirement plans on either an individual or group basis. In some cases, the plan receives tax deferred and tax deduction, such plans include COF plans, simplified employee pension SEPs, 401k plans, pension plans, and profit sharing plans. So pension and profit sharing plan may be established as defined contribution or defined benefit plan. So the other thing we're going to discuss again now is defined contribution or defined benefit plan. So a defined contribution plan specifies the amount each employee contribute to the plan. So this brought us to one question. I always want those who are going to job interview tomorrow, next tomorrow. You call you for job interview. You know, we are so excited when the company, when the employer told us that, look, after the interview, they told us that, look, we have a lot of benefit. We have health, we have a life insurance policy for you. We have this, we have that, we have data, we have a vision, we have that, so as to push you to agree. But however, one question issue left to them is this. Is this plan contributory or non-contributory? You ask them, is it contributory or not contributory? They're going to give you all this health or plan, this and this, this and that. Ask them, please, sir, please, ma. After the interview, they ask you, do you have a good question? You say, all right, based on the plans that you guys, benefits you guys have for staffs, this one, is it contributory or non-contributory? They say, oh, it's contributory. You ask them, oh, that's wonderful. How many percentage contribution, please, man, or please, sir? How many percentage are you guys contributing? And how many percentage is the employee contributing? If you ask them that question, that will shake them. They will not know that you know what you're doing. And if they tell you the percentage, probably you have another interview some other place. You ask them the same question, you not check the two. Because giving you all those benefits, health, eye, dental, this and that, you don't know whether they are contributing or non-contributing. If they are contributing, you don't know how many percentage they are contributing. If you do interview in two places, be able to compare which of them contributes greater percentage than the other. Normally, they contribute 65 to 75%. But most companies go and learn to contribute 50, 50. The employee is contributing 50. They are contributing 50. So is your duty to ask how many percentage?
Mute that phone coming. Mute that person, please.
Yeah,
Please mute them.
So is your duty to ask how many percentage are they contributing? If you are contributing, how many percentage are they going to be taking from your paycheck? Yes, because some of them, they say, oh, it's contributory. Meanwhile, the employee is contributing 75, they are contributing 25. That is not contribution. They say they're matching, that is matching. Let me use the better word, matching. How many percentage are you matching? However, if they are matching, let's assume they say you match, they match 6%, or they match. If they match, don't go above what they're matching. That is another secret. Always, if they match to 20, match 20. If they match 10, match 10. They don't go above it. If you go above it, what happens? You are going to pay tax more on the one that's above. Because what happened to it is this. Remember, whatever you are matching is pre-tax, because their own is pre-tax. And they will turn, oh my God, they will turn around to say those ones you call 401k, they match to you, they will turn around to write it as a company expense. Let's not go there. All right. So we're talking about qualified annuity plans and non-qualified plan. We have finished non-qualified plan. Of course, all of us know what qualified plan is. What are they? You know that it's 401k and all the rest. They're a qualified plan. So a defined contribution plan specifies the amount each employee contributes to the plan. A defined contribution plan means that look at the amount the employee will be contributing is defined. In contrast, a defined benefit plan specifies the benefit amount the retired employee will receive in the future. Defined contribution plan is the amount the employee will be contributing. Defined benefit plan specifies the amount the employee, when he or she retires, the amount he will receive in the future. So all those is what you have to find out from your company to know what you're going to benefit if at all you're going to stay there to retire. Or even if you're not going to stay there to retire, you are invested. When they say vested, means that you have reached a point that if you get out from that job, whether you terminate yourself or let's assume resign, if you invested in that company, you will still get the benefit that due for you. Where I work, I invested on it. In fact, I stayed 6 years that place. And the reason why I stayed there 6 years is to be vested on it. So I invested, I get out. Now I have retirement benefit there. So tell me the reason why you should stay in a company in one place for almost 30 years. You are still there working there. The other people, they don't stay up to 30 years in one place. They make sure they go and get another place.
Because you don't know what you know.
So you get, your own intention is to get vested in a particular place. You get vested, you are qualified to get whatever there, you get out. If you're not the manager, why must you stay one place for 10 years, 20 years, 30 years? You're still working in one place. As if you can't get a job another place. Let's go ahead. Let's not just go back, go far. There are people, they stay 5, 6 years, they get invested, they just get out. Go another place. All right. Tax sheltered annuity, which is 403B or 50C plan. So, like me, I have 403B. This tax sheltered annuity is only for companies with 501C, which means non-profit organization, churches, sometimes ministries, sometimes government jobs. They have 403B. Like in some states, they have TSA, TSA means that their job related to either government job or teaching or some other things like that. So that's what it is. So the tax sheltered annuity or TSA is a special type of annuity plan reserved for non-profit organizations and their employees. So this is 403B. TSA is named that in some institutions, but it's the same thing as 403B. So such a plan is also referred to as 403B plan or 501C plan because it was made possible by those sections of the IRS tax code. For many years, the federal government, through its tax laws, has encouraged specific nonprofit, charitable, educational, and religious organizations to set aside funds for their employees' retirement. So regardless of whether the employees of this organization set aside the money or the funds are contributed by the employee through salary reduction, the money being placed in TSA can be excluded from the employee's current taxable income. So it's left to you to go and say, oh, I want it to be, even as much as what they excluded from current taxable income, that I want to pay the tax now instead of paying it tomorrow. Because definitely, but from all indication, tax will be greater tomorrow than today. It tax is cheaper today compared to what it will be tomorrow. That is the truth. If not, all right, go back to where if you have done your university or high school education here, go back, college degree here, go back to there now where you have worked several years ago, check the amount you're paying for a course that you did that time compared to what they're paying now. So tax will always be higher tomorrow than today. That's the truth. So this is the exam tip. It's an exam tip. In addition, TSA and IRS, annuity are an acceptable funding mechanism for other qualified plans, including pension and 401k plans. So annuity can accept all of them. As far as you are no longer working in that place, annuity is there to help you. Structured settlements. Annuity are also used to distribute funds from the settlement of lawsuits or the winning of lotteries and other contests. Of course, most people who have won lottery, those who have been advised by a good financial professional or financial counselor, as case may be, will always invest wisely when they win their lotteries. So such arrangements are referred to as structural settlement. That is, you win a lawsuit that have a massive money. The company will say, please, can we do a structural settlement? If you agree, so part of that money are invested in annuity for you. But however, when the investors who is the contract owner? Is the company still the contract owner? Then you add annuitants. You see?
Say that again.
Let's assume you win a law court.
Mm-hmm.
When you win a law court with a massive money, the company do not want to pay you the money in lump sum because they pay it in lump sum, they will lose. Not only losing, it will shake their company. Their foundation will shake because they have spent much they don't expect to spend. So which means if they lose it, funding will become difficult for them. So based on that, they will ask you, please, can we do a structural settlement? A structural settlement is that part of that money is put into annuity for you. People who win lottery too, they used to do it for people, they do it for people who win lottery. The lottery companies still want to become part of the money because the money is so huge that they don't want to lose it totally. They don't want to give it to you totally. They will say, we're going to do structural settlement. And you, if you don't know what structural settlement, maybe you ask them, they will explain it as they can explain it. They will not explain it to discourage you. They will explain it for you to agree on it. That is the truth. They're not going to explain it to discourage you. They will explain it for you to agree to their discussion. So they do structural settlement. You will agree with them, that money they put it into annuity. So when they put it in annuity, what happens? You become the annuitant. Remember, the annuitant is that person who collects the money. You know, when the amortization period comes. So if they put it in annuity, they still have the principal. They will pay you some money from the proceed from the interest that comes, because such money is massive. So even if they do immediate annuity, in the next 30 days, they will start getting income from the money to pay you. Because such money is a lump sum, which is immediate annuity, which generates settlements start 30 days after. I hope we have seen it, we have talked about it, so everybody knows about it. So if they put it there, that's settlement option. Within the next 30 days to 60 to 90 days, there's be interest. So they'll be paying you your money on the agreed amount from the interest. So the money is still there for them. They are still making their money. So they don't want to pay you huge sum at a go. No. It's happened in lottery or when people win a big case. So that's how it is.
So how about if the person insists that she wants some of the money cash and wants some not to the immediate to fix index annuity? Somebody who has a knowledge like this.
Yeah, you can, when you have the knowledge, you can begin to negotiate based on your knowledge. But however, it now becomes an argument between you and them. But they always want to dance to your tune because for now, it's basically
you are the boss.
You are the boss then. So if you have the knowledge, they're gonna discuss based on your knowledge. But if you don't have the knowledge, they will remove you. They will do as if they're doing good thing for you. No, that's the truth.
Yeah.
They do as if they are doing good thing to you. Very wonderful thing. As if in fact, of course, they're going to go and bring somebody who they call specialist. That specialist will be talking to you as if he owns your brain. But if you know it, they begin to argue. And when they know that you are right, they will mellow down. They will calm down. Yeah. Of course, they will now tell you, refer you to one financial counselor, which is maybe one of them. So
I told you, if I tell you I have my own financial counselor, uncle, I bring in Dr. Ruth.
If you bring in Dr. Ruth, you go question them, they go run.
I know that when people win those massive amount of lotteries and they want to collect lump sum, the tax is almost like 70%.
Yes. So you see, when they give you that tax, you agree to other arrangement they made.
Yeah.
You'll be forced to agree to other arrangements.
Like that big massive mega $1 million and that is rolling into $1 billion now. They can't pay you $1 billion if you win it and you say you want a lump sum. No way.
They can't pay.
Yeah.
They can't pay. So you have to go, they will go to a structural settlement where they will structure it how it benefits you. Whether it benefits you or you lose it, that was not a business. So business uses of annuity. How does business use annuity? Executive compensation. What is the first compensation plan using annuity to reward key employees? Of course, business succession planning. Always the same thing that happened in a life insurance. That's what happened here. Key persons insurance, which is key employee. Corporate pension plan, funding future obligation, cash management, employees retention, and asset protection. So all this is the basis of you understanding life insurance policy and annuity contract. All these are the things you should know. We begin to use them, even the small amount you're making in your job, put this into practice, all this into practice. That will benefit everybody. All right, so individual versus group annuity. Can individual have annuity? Of course. Can group have annuity? Of course. In life insurance, can individual have policy, life insurance policy?
Yeah.
Of course. Can group have life insurance policy? Of course.
Yeah.
So there's a name we call when a group go and get life insurance, but that group is not specifically formed to have life insurance policy, but decide on their own to get life insurance policy. What do we call that name? It's always in the exam. Can anybody remember?
Say that again.
What did you say?
What I said is this: is a group formed, but not basically for life insurance. They formed that group, and at the point they decided they want to get in policy for themselves. What is the name? What do we call that name?
Is that mutual? No.
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 I think I've said this several times here.
It's like a business, whatever.
It's always in the question, and I'm trying to recollect it. It's always.
So what is that?
Is that fraternal?
Fraternal, good.
Okay.
Good. You got it. It's got it. So
what did you say fraternal is?
It's fraternal. What fraternal? Fraternal is an association. It's a non-profit organization. They formed not because of life insurance policy. They have their own things they are doing, but they go ahead to get policy for everybody. You get for me, I get for you. Whatever they do, what they do now, they now appoint an attorney that goes to make sure that those things are formalized. So that's fraternal.
They get the policy. Every person get the policy for themselves or for the, like, if
for
between
instance,
me and you. I get for you.
You
Then
get, I get for me, I get for you, yeah, something like that. That's how we done. It's fraternal. They call themselves fraternal. I think we see it on chapter 1. You can research it and get more knowledge about it. Sometimes it's in the question. I just remember it, and that's why I threw it up.
Fraternal what? What's that?
Fraternal. That's fraternal insurance. Just can type fraternal insurance. Let me see. We still see it when we go back to chapter 1. But let's, if you're here, if you never take personal benefit society.
I think it's chapter 3 or so.
Yeah, fraternal benefit society. We call them fraternal benefit society. Yeah.
You call it?
Yeah.
They form for mutual heirs benefit, for instant insurance for relief from sundry difficulties. So it's fraternal benefit society. So you can just go read it and read it up and find what it means.
Yeah.
In case if you see it in an exam, fraternal benefit society, that's what it's called. All right, so individuals can get, of course, individuals can purchase a single person directly from an insurance company and customize to the individual specific needs. You see what I said? You don't just buy policy or buy annuity because you want to buy it. You must have what you have in mind. And that what you have in mind is individual specific needs or family specific needs. Yes. Let's buy this policy to protect our children. Let's buy this policy for our children's school tomorrow. Let's buy this policy so that tomorrow our children can get cash out there to go and buy a home. All those things depends on what you need. And based on what you need, you have to design it, tailor it to your own needs. Yeah. The one you buy to protect yourself in terms of riders attached to it will not be the same as the one you bought with the basis that, look, I'm tailoring this policy to accumulate for my children to go to school tomorrow. I'm tailoring this policy to accumulate so that tomorrow my children can take it as a loan to go and buy a new home. Oh, I'm tailoring this policy to see if my children tomorrow are sick, this policy will protect them. They are not the same. So the basis of your family needs and their individual needs is what drive you to designing a specific policy or annuity contract for yourself. So no employee involvement required, of course, that is individual. Group, we talked about group policy before, is almost this, is very low cost, often part of employer sponsored retirement plans, of course, may offer pre-tax contribution, usually tied to employment with the sponsoring organization, of course. Should not waste our time there. Then we have stability in annuity investment. Remember, I talked about stability before.
That's right.
So now let's see what it actually means. You want to buy policy. Remember, in life insurance, if you want to buy life insurance, they always want to ask you what is your annual income. You tell them, my annual income is $100,000. $100,000. A good experienced agent will ask you, oh, $100,000. It will ask you, you do what we call financial need analysis. Based on this $100,000, a good agent wants to do financial need analysis, what actually your family needs, and what amount of life insurance that is okay for you and your family. However, everything will total down to 20% versus 80%. 20% versus 80%, which means that's your annual income of 100,000. We divided into 20% to 80%, which is 1 out of 4. Ratio of 1 out of 4. The 1 ratio is what you're going to use for your life insurance policy, or 20% is what you're going to use for your life insurance policy that will cover the whole family. If the whole family makes $100,000 annually, 20% of that $100,000 is what the insurance company will approve you guys for. He cannot approve you more than 20%. The remaining 80% will take care of every other things you have. So ordinarily, they will not tell you that, but based on that, that's what they do. That's what they want to know, your annual income. Based on your annual income, they will now say, look at the amount of policy you need. They will not go above 20% of your annual income, no, because they still want you to be able to pay for the policy. So that is for life insurance. Then in annuity, the only qualifying criteria in when you pass stability put the two on the table and look the one, if your investment is more than your expense, of course, you pass a stability test. If you pass a stability test, then so many insurance companies will pop up for you to choose from anyone you want, based on your needs, based on the interest, based on the percentage of interest that will be there, based on what they provide, they offer you. So you make a choice based on that. There's a different choices, what we tell all your choices, different things that tell all your choice. So insurers and insurance producers must have reasonable standard of determining whether an agent's recommended transaction meets the consumer's insurance needs and financial objectives. You have to know your what? Consumer or you want writing a policy must know your insurance needs and the financial objectives. It must guide you. So a producer cannot recommend the purchase, sell, exchange of any annuity contract unless the producer has reasonable ground to believe that the transaction or recommendation is suitable for the person to whom it is recommended. So remember, you are the producer, you are the agent, and you are also the feed underwriter. So I want you to know, most people, when they see the word producer, they think it's a shop. You are the producer, you are the agent, you are the feed underwriter. And as a feed underwriter, you are the first port of call. You are the first person who sees the agent. You are the first person who have encounter with the agent. So sometimes, I mean, with the customer, sometimes if we see the question, who is the first person who made the call, who first sees who talk with the agent? I mean, with the customer, they put producer. They will not put you as the agent. They put producer, put other names, put underwriter, put all those in to confuse you. Remember, you are the agent, you are the producer, you are the feed underwriter. So in the case of feed underwriting process in a life insurance policy and annuity, of course, there is no underwriting process in the annuity. But in the case of feed underwriting process in the life insurance, the feed underwriter is the person who initiates, who starts underwriting process. Because when you speak with the client or the customer, that's information you gather from him or her is what you're going to send in the form of statement or representation to the feed underwriter, which is you, and the underwriter in the office. So in annuity, this person is qualified if that person passed what we call suitability test. I've told you what suitability test is. So that will bring you to know that before this person buy this policy or enter into the contract of annuity, that person must know the reason and why he should have it. He must know his insurance needs or financial objective before he can go into it. And who will provide those needs and financial objectives? It will be based on your interaction, your education, for him to understand. I told you I have the first policy 2007. That's the first time I have life insurance policy. But because I did not have a good understanding, neither the agent explained to me what it is. All I know is that about policy, I don't know what it is. But if a good education was provided to me, I wouldn't have buy term life policy. No, I wouldn't have. Because I received a good education. Based on the education I received, I could be able to make an informed decision. But I do not make any informed decision because I do not know. And
I
believe
bought,
me, I don't
I
think the
bought,
agent knows either.
I bought a lot of term life, paid many years, and then when it ended, and then they increased the money, I just stopped that one.
Oh.
All of us are a victim. So this is, and when you stop it, did they refund you any money?
No.
All right.
Actually, actually, one time I had a Universal, and I think it was in 2008 when the first housing crash, and they told me that I have to bring more money to bring because the interest rate, I've lost every money I have there, so I should bring more money. And what I need to bring to was so much, I canceled that once. because it was tied to the
mortgage.
Yeah, market, and then the crash, that 2008 market crash, and all of a sudden I had this amount so much here, and now all of a sudden I have nothing.
Yeah, what they have then is just like whole life.
And
it's not,
for it to,
it was
continue,
not.
Yeah, they say I have to bring almost $3,000 so I can, and I didn't have 3,000 cash to give you.
No, what they have there is just ordinary whole life.
Yeah, I think it's, I don't know, yeah, it's whole life or something, you know.
That's what I say. If you have a index, fixed index universal,
No, it wasn't.
It will not have any effect with you. Whether the market go down, it's not your problem. Nobody asks you to bring money.
Yeah. Oh boy, yeah. They
It's-
don't chop me fire for America.
It's education. It's education. It's education. Don't worry, you will recover.
Just because I'm trying to make sure that if anything happens to me, my family is okay.
Yeah. At least you have a good heart. It's okay.
No. Let me tell you, it's good.
What a man.
It's good. It's knowledge.
The last one was term life. I think it was 10 years. It just ended, and it went from a few hundred to almost $700 every month. because of my age, I said sorry.
You said to hell with them, right?
If I have that kind of money every month, I won't need life insurance.
So you can see.
I have a question, General Bat. He said something now. Everyone said something about the whole life. I thought the whole life is fixed, but it doesn't. The market doesn't affect it. It's permanent and fixed, both the premium and the benefits.
Remember, we did different types of life insurance where we talk about whole life and term insurance. Remember, all those are what we call traditional. Then when we enter into non-traditional whole life or non-traditional permanent life, that's when we begin to see index, fixed index. Did you remember that? So remember, there's some whole life that they have only cash value. They are not indexed.
Yeah,
So,
mine has like cash value, but it's tied to the market.
Yeah, that's not. It's not indexed.
So tomorrow the market
is not
high,
and it's not indexed.
and I have $300,000 there. Tomorrow the market is flat and I'm zero.
No.
Yeah, that's what happened to me.
So
what kind of no?
Are you sure that one is
this
if it's taxed to the index? I don't think
it wasn't indexed because this was what 2002, 2003
variable.
You know, so this was years back. You know, when I come to America first, and I wanted to start this.
But I'm in a meeting,
you know,
I'm hearing everybody.
Are you sure it's not the participating that he was doing? I don't know.
So
when there is loss with them.
Yeah, these are all tied to the market. So it's like you're buying a stock. Then if the market is high,
so you say it's life insurance?
Yes.
I think that may not be Just check well what it is.
I'll look
Yeah.
at the letter.
Check well what it is.
Yeah, but
I
it
don't
was
think it's
I
life
remember
insurance.
I had it from about 2003 until the market crashed in
So
2008.
you know what you do? You know
Yeah.
what you
I have
do?
the letter they read me.
Yeah, take all the papers. Now that you have getting to know the law, bring all the papers to your table and examine what you have, what they write for you.
But it's a
Because
long time ago, yeah.
basically, those things they write for you, the agent write for you. Maybe the agent may not understand what you write. Let me tell you something.
No, I fought them. I wrote them back and they said,
Yeah.
well, this is how much was there because of market crash, everything you lost everything in your account. So if you want to bring your account up to par, in other words, I don't have any more money in my insurance unless I pay almost about this time was about $3,000 or $4,000.
Yeah, go back
So,
now that you are getting knowledge. Yeah.
Yeah, but it's a long time ago, yeah.
Mr. Zemwa, see what you do. Now that you are getting knowledge, gather all those papers, begin to go through them, one after the other. You now understand what you have. Let me tell you guys one thing. They have this person that an agent wrote a policy for. The agent wrote the policy and do not include any rider, even the free riders on it. You understand? The agent wrote the policy and he forgot to include riders on the policy. So he can see the basis of why you, being an agent, you should be able to know what they are writing for you.
Yeah.
So there is need for that.
Yeah.
So there is good need for that. You understand? There's good need for that. So you understand what you have. Based on your own understanding, you can be able to help to design what you want. I said some people write policy without adding free riders, chronic and critical riders that are free given to you. They don't.
That's why when I listened to the presentation, I went back and dug out my old Texas Department of Insurance certificate. I have a general lines, L, H, and HMO licenses and the company I was attached to that time, it was called Cornerstone.
And even that time, you are what they call
I just go to people and tell them to buy life insurance. That's all. Yeah. I didn't know any of these other things. All these other things now.
Oh my God.
When I finished doing presentation, I forgot what forget what the man said.
Is it? Then
the man said
you were a captive. You were a captive agent. You are
my wife.
The
man said, I like this. I would like to get it for myself, but my wife would prefer to buy my insurance for my dog than to buy insurance for us.
So, besides you are then a captive, what we call a captive agent, which means you can sell policy for one insurance company.
Yes.
That is another problem we have.
Yeah.
When you pass your license, they'll be calling you to make you a captive agent. If you're a captive agent, you cannot have varieties. You only sell one product. You cannot sell different product. But here, you are an independent licensed insurance producer, meaning you are licensed to work with more than 100 insurance companies. So based on that, you have varieties, you have alternatives.
Yeah.
Yeah, so that is the difference. So anyway, now that you know, you just go back and begin to go through all those things and find out what went wrong and what actually they gave you. But however, there's one thing you would have added to that policy.
Rider.
Yes, like me, I wrote my first term policy 2007. I was afraid. People that in the same office with me were laughing at me. So at a point, I now asked the man, say, what if tomorrow I couldn't pay again? How can I get the money? He said, oh, if you want me to put a rider for you so that you can get your money if you stop. I said, yes, put it. So he put it. So now today, if I decide to cancel that policy, what happened? They're going to give me back my premium and do what? And remove all their charges and give me back my premium. So all those things based on our understanding. I asked that question that day because my colleagues in the office were laughing at me. So that's what it is. So anyway, you are getting the knowledge there, begin to make an informed decision.
Question, if you have a policy, where do you find the riders in the book?
If you have a policy, you will see, you go to the summary booklet.
Oh, okay.
You will
Okay.
see everything on there. You see the riders you have attached to the policy. Yeah.
Okay, thank you.
Yeah. It's a very good thing to add. However, there are some free riders. There's one or two riders you get to add to your policy to make it more beneficial to you. So that is the thing. All right, so suitability is what? Is based on the producers conducting what? A reasonable inquiry regarding the applicant's insurance objective, current financial situation, insurance needs, and risk tolerance. So that's what suitability do. Based on, I've told you about the investment, about the expenses, they want to bring it together to know whether you pass stability test. If you pass stability test, you can get as much as annuity as you want. Annuity and taxation. Already, what you know about taxation and annuity is that they tax you the interest. Whether it's the money comes from qualified or non-qualified account, they still tax you the interest. They tax the interest. And if it comes from a qualified account, they're going to tax the principal plus the interest. But if it comes from non-qualified account, they will only tax you the interest.
The interest.
So the government, Mr. Uncle Sam must get his own part of the money. So the exclusion, there's always an exclusion. Even in life insurance, we have exclusions. Those things that they cannot cover. That's the exclusion ratio. So this one is, I think, is above our. Listen, we're not going to look at it. Let's not go much on it. Early or partial withdrawal. There's always a cash surrender value. When you withdraw early, just as it applies in 401k, when you withdraw early, you pay penalty. That's what it is. Then when you decide to say, you don't want to do no more, you want to cancel, you want to collect it, they will give you a cash surrender. Cash surrender will now, based on the principle, they will remove charges from it and now give you the remaining. That is a cash surrender. I just want us to get this done and enter another thing. Distribution at death. Of course, you have to decide how this money will be distributed to you. You have to decide what it is, how that money can reach your beneficiary. Remember, some people do not want beneficiary. Whatever remains, they say they should give to government or they should go to their estate. And when you go to their estate, what happens? After paying their debt, the remaining ones go to the government. So that is it. We have already finished everything here. 1035 is contract exchange. You use 1035 to transfer. If you like somebody that have term life insurance, you can convert your term life insurance to whole life insurance using 1035. 1035 is just a paper. They give it to you, fill, sign your signature, submit to them. They will transfer your policy from term to a whole life. And equally the same thing in annuity. Corporate owned annuity. Just you have corporate owned policy. If you have contract, if you have company here, you can do what? You can have key employee policy. And if you have a key employee policy, what happens? The company pays for the premium and the company is the policy owner. So what they do, like in a key employee policy, is that at the time, maybe that key employee died or anything, or maybe he or she just resigned. You're gonna collect the money, use it to what? Train another person to bring that person to the level that key employee was. So that's what key employee have. It's the same thing in corporate owned annuities, the same thing. This is a chapter summary. We're not gonna go back to it again. Then let's listen to this.
Hello, sir.
Yeah, go ahead.
Lisa, can you explain that key employee stuff you're talking about again? Please just throw more light on it.
All right. Key employee policy in every organization, whether 2 people or 3 people. In fact, if you have a company today, you have a registered organization or a registered company. If you have anything, there is this person that no matter if that person is no longer in that company, he's gonna shock you. So you're gonna shock the company. So what you do in that aspect is to put what we call key employee policy. The key employee policy, who have the policy, the company. Who pays the premium? The company. So later on, that company will now use that policy, premium they paid as what company expense. So when you are filing tax, it becomes an expense, which means you're going to reduce your tax. Because what is tax? Tax is the profit, the sales minus the profit. That's what remains is what the tax, the profit is what the tax you on. The expenses minus the gain. What you have, the total cost minus the expense. Then what you have is what is profit. So the tax on profits. But when you have this a key employee that you have paid premium in form of if you have paid premium, that premium will now be a company expense. So it's going to reduce your tax you are paying. That's what people don't know. You can do executive bonus too, where you write bonus or yes, you are the executive of that company. You write executive bonus. Who is paying the money? Your company. After, the government will see that money you are paying as a premium as company expense. It will reduce the tax you're going to pay. So these are a series of things you're going to learn here. All right, so let's listen to this. After that, we answer the questions. All right.
Great job completing the annuities chapter. You've navigated the complex world of annuity contracts and their role in retirement planning. Let's review the key concepts to reinforce your understanding. We began by defining annuities as unique insurance contracts designed to provide income security and protect against the risk of outliving one's assets. Unlike life insurance, which creates an estate upon death, annuities systematically liquidate an estate through guaranteed income streams. This fundamental difference highlights their complementary roles in financial planning. We identified the key parties involved in annuity contracts: the insurer who guarantees the payments, the contract owner who purchases the annuity, the annuitant whose life determines the payment schedule, and the beneficiary who receives any remaining benefits. Annuities can be classified in several ways. First, based on premium structure. Single premium annuities are funded with a one-time lump sum payment. They can begin paying income right away, immediate annuity, or be deferred to start later, allowing the investment to grow tax-deferred. No additional contributions are made after the initial payment. Level premium annuities require equal payment amounts made on a fixed schedule, such as monthly or annually, until the annuity is fully funded. Flexible premium annuities allow the owner to make payments in varying amounts and on their own schedule, offering more control over funding the annuity. Immediate annuities begin paying benefits shortly after purchase, typically within 30 days to 1 year. Because payments start right away, the insurer requires the full premium up front. These are commonly referred to as single premium immediate annuities, SPIAs. Deferred annuities begin paying benefits more than a year after purchase, usually 10, 20, or more years. This accumulation period allows the annuity fund to grow over time before payments begin. Deferred annuities can be funded with any premium payment plan. Remember, the name can give you hints about how the annuity works. A single premium deferred annuity was funded with a single premium, and benefits begin sometime after the first year. We also explored classification based on the source of income. Fixed annuities guarantee a set income amount, providing predictable payments over time. The insurance company assumes the investment risk, meaning the payout won't fluctuate with market changes. This makes fixed annuities a stable option for individuals seeking reliable income, especially during retirement. Variable annuities provide income payments that fluctuate based on the performance of underlying investments, such as mutual funds. Unlike fixed annuities, the contract owner assumes the investment risk, meaning payouts can increase or decrease depending on market conditions. This option offers growth potential, but less predictability, making it suitable for individuals comfortable with market exposure. Indexed annuities link returns to a market index while protecting principal, offering a middle ground between fixed and variable options. The chapter covered various annuity settlement options, each with different guarantees and payment structures. Straight life annuities provide the highest regular payment amount because they are based solely on the annuitant's lifetime. However, they offer no survivorship benefits, meaning payments stop when the annuitant passes away, regardless of how much was paid into the annuity. This option maximizes income, but carries the risk of leaving no remaining benefits for heirs. Period-certain annuities guarantee payments for a set period, such as 10, 15, or 20 years, regardless of whether the annuitant lives or dies during that time. If the annuitant passes away before the period ends, payments continue to a designated beneficiary. This option offers a balance between income security and legacy planning. Life with period-certain annuities combines lifetime income with a guaranteed minimum payout period. If the annuitant passes away during that period, such as 10 or 20 years, the remaining payments continue to a designated beneficiary. If the annuitant lives beyond the guaranteed period, payments continue for life. This option balances income security with a safety net for loved ones. Life with refund annuities ensure that the original premium is returned, either to the annuitant or a beneficiary. If the annuitant passes away before receiving the full value of the contract, the remaining balance is refunded through one of two methods. Installment refund is a process where continued payments go to the beneficiary until the full premium is repaid. Cash refund is where the unpaid balance is returned as a lump sum. This option provides peace of mind by guaranteeing that the initial investment won't be lost, even if the annuitant dies early. We examined important annuity characteristics, including surrender charges, fees applied when funds are withdrawn early, typically within the first several years of the contract. These charges start high and gradually decrease over time, encouraging annuity owners to keep their money invested until the surrender period ends. The tax treatment of annuities is a critical consideration. We learned that interest grows tax-deferred during the accumulation phase, meaning you won't pay taxes on the earnings until you begin withdrawals, typically during retirement. This allows the investment to compound more efficiently over time. The exclusion ratio is used to calculate how much of each payment during the distribution phase is tax-free. It separates the return of principal, non-taxable, from earnings, taxable, ensuring only the appropriate portion is taxed. Withdrawals made before age 59.5 typically trigger a 10% early withdrawal penalty, in addition to being taxed as ordinary income. This discourages tapping into retirement funds prematurely. Finally, we discussed suitability. Suitability ensures that annuity recommendations align with each client's unique financial goals, risk tolerance, and personal circumstances. It's a key part of ethical and compliant financial planning. Understanding these various aspects of annuities is essential for advising clients on retirement planning and helping them secure income they cannot outlive. Keep reviewing these concepts, especially the distinctions between different annuity types and the various settlement options. Remember, the exam will test your ability to identify key characteristics and recommend suitable products for different client situations. You're making excellent progress. Keep up the momentum and remember, each step helps you prepare to pass with confidence.
What? Is in the garage? Oh no, I think the garage, or go to that place you put water. Or you leave it. When I finish, I get it. All right. So we are done with it. These are review notes. It's just the same thing we revised before. The review notes is just a summary of everything we have discussed. For instance, we talk about, I don't want to go through it, you're going to waste our time. So
yeah, let's go to the
so let's go to the
question.
exam, yeah. All right. So we're going to go to annuity exam. Tomorrow morning, we're going to do uses of life insurance. For this, chapter 10, chapter 9, chapter 8, chapter 7, chapter 6, and chapter 5. Of course, including chapter 4, is very, 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 very important, honestly.
Say that again.
Most of the questions come from these chapters I've just mentioned now. It's chapters you cannot avoid.
Which chapters?
Let's start with all right, chapter 3 too. Chapter 3, legal concept of insurance, is very, very important. Chapter 4 is telling us of life insurance policy types. You want to know the policy, the type it is. It's very, very important. Chapter 5, life insurance provisions, options, and riders. Very, very important. Chapter 6, life insurance premiums, proceed and beneficiary. Good. And chapter 7, life insurance underwriting and policy issues. This one is so large, and most questions come from it. And some of the questions that come from it are scenario questions. Then chapter 8, of course, is a very small chapter, group life insurance, the type of insurance you have at work. Then chapter 9 is the annuity we're talking about. Then let's go to the exam. So remember, the best way to do this exam is to think twice and to do elimination. 4 options is always in the exam. I mean, in the 4 options in each questions. So do not waste all your time thinking on the 4 questions. Just do elimination, throw away 2 options and then fight on 2. If you're fighting on 2 options, the chances of you getting the answer correct is 50-50. But if you are fighting on 4 options, you get confused. So just look at the options and let the 2 options they are out from your list. Then concentrate on 2 options to get the final answer. So this one say, how does an index annuity differ from a fixed annuity? How does an index annuity differ from a fixed annuity? Based on what we study, you should be able to know what is index annuity, what is fixed annuity. So how they differ?
Fixed annuity must have separate investment account. Fixed annuity receive credit interest tied to the index annuity on B. B, boy.
Somebody said D?
Yeah, B.
Any other person supporting her? We always take 2 answers. D, who supports D?
B as in boy.
I think D.
B as in boy.
I think D.
2 persons said D.
Yeah, I think D, yes.
He said B.
No, I say B.
Oh, you said B. 2 persons said B, sorry.
Chinyere said B as in boy.
All right.
That's what I said too.
B is the answer. So index annuity owners may receive credited interest tied to the fluctuation of the index, linked index, of course. That is index annuity. So the correct answer is index annuity owners may receive credited interest tied to the fluctuation of the market trend. An index annuity differs from a fixed annuity in that index annuity owners may receive credited interest tied to a fluctuation of the linked market.
Come down here.
Credited interest linked to what? The market trend. That's what it means. Market trend. When you hear of market index, you're talking about market trend. What is happening out there in the market? So this one says,
I was referring last call. I need this in these are the 3 of them.
My goodness.
All right. I think I've
immediate annuity.
All right. An immediate annuity consists of what?
Single premium.
Single premium.
C.
Somebody says C.
Yeah.
C.
All right. An individual who purchases a life annuity is given protection against what?
The risk of that, the risk of having enough retirement. Yeah, the risk of living longer than expected. That's B.
Is D
Yeah,
as in dog.
yeah,
as in-
between B and D, which one?
It's
Is
B
D as
as
in
in
dog.
boy.
Hey,
B as in boy.
Two persons say D.
I said B.
the
I said
risk of
D.
not having
Right.
enough retirement income. Mhm.
D.
Yeah,
Two persons said, other person said
B.
it's B.
I said,
Oh, B.
I know it's B.
The risk of living longer than expected.
The individual who purchased life annuity is what giving protection against the risk of living longer than expected. Remember that life annuity gives protection for life. So since it's giving income protection for life income stream for life. Hold on. Let
Oh,
me.
sorry.
Don't worry. Anybody stop talking. All right. So an individual who purchases a life annuity is given a protection against what? I want everybody to remember what we said about life annuity. Life annuity produces income for life. Remember, in the distribution phase, you can do life annuity that will giving you income if along the line the person dies without collecting all the money. The remaining benefits go to the insurance company. So that
Really?
life annuity income for life does not have a beneficiary.
Oh, I didn't
So
know that.
is the risk of living longer than expected. It's not inflation. It's not risk of dying prematurely. It's not risk of not having enough retirement income. No. It's the risk of living longer than expected. You want to prevent it in case you live longer than expected so that you can be able to have more. Remember, at life annuity, the insurance company, their prayer will be, let this person die quick. Because they know that if you die quick, the remaining amount will go to their pockets. All right. So this one say, T has an annuity that guarantees an income payment for the rest of his life. The contracts also guarantee that if T dies before receiving payment for 20 years, the remaining payment will be paid to his son for the balance of the 20 years. What type of annuity is this? Remember, I told you the one that will no refund. Then what is this?
That's a period certain.
D. D as in dog.
D as in dog.
Period certain.
Any other person?
I would say C.
It's
Any other person?
B.
We want to,
Annuity with period certain.
all right, so,
Yeah, D.
all right. So, annuity with period certain is the one that you can talk about beneficiary. I think we did it in the morning.
Mm-hmm.
The one to talk about the beneficiary, and I think I took my time to analyze it so that everybody will understand it. Annuity with period certain means that beneficiary are concerned. Annuity without period certain, that one does not consider any beneficiary. Please know that. I told you guys to write it down. The payment on cures annuity are no less than 250 quarterly. Which of the following annuity does cure own? What type of payment plan do we have?
The payment
Premium
on
payment.
pure annuity are no less than 250 quarterly.
I would say D.
Quarterly. Flexible.
Is it A?
Well, flexible
It's
installment.
not B and it's not C.
A.
So between A and D.
Let's A.
So between what?
A and D as in dog.
There's no between. If you
Go A. If it didn't work, it didn't work.
Any other person?
I said D.
Somebody said D
Never
as in
arrange it.
dog.
We want two persons in one answer.
I say A.
All right, two persons say A.
I take B.
Hey.
Is two persons say A or two persons say B?
B.
I need two persons in one answer. We are
B.
15 here.
Yeah, B.
You say B, or nobody supporting you?
Me, I don't know.
I'm sorry.
All right, someone support him.
Yeah, no.
Yeah, I don't know, please.
I will support A, Anna.
All right, someone support A. All right.
And support
Me,
yourself.
B. I said B.
Support yourself.
Oh, nobody's supporting me. A.
See, nobody supported me.
Oh, I support A. I
Support
support A
yourself.
now. I was between A and B, but I finally said I will support A.
Say A and I support myself. That's true.
Right. You see why we are doing, most people like see other people that are doing some other people that are doing all this
250.
exam review. What they do is that they go and answer the questions without knowing the content. So I introduce going through the content. The essence of going through the content is to make you know, so that you know what you're answering. So that you not be, you just close the eye and take one. If you close the eye and take one in exam, definitely you're going to fail. So any option you choose, you must know the reason why that option is the answer. You don't just say this or no. That is not how to answer question. You must answer, you must choose a point and know why you choose a point. Let me tell you, in annuity premium payments, whenever its period is level, it means that you are paying the same thing every time. If it is deferred or flexible, it means that the premium, you can pay $10 today, pay $20 tomorrow, pay $100 the next day, pay $500 today. So it now based on your earning what you can. But if it is level, you are paying exactly the same thing, exactly at that time you are paying it. Of course, that's what we are paying in term life insurance, in level term life insurance. The amount you are paying, you pay it exactly at that day is due. But flexible means that you can pay any amount at any time you feel that you can afford it. Some people can decide to pay quarterly. Today, they get money, they say they want to put $10 into their account. They put. So that's flexible.
But you see, this, yeah, I understand that, but this is very confusing because he's paying no less than $250 quarterly. So I would say it's quarterly flexible, which is
no.
Yeah.
I think
but
because
it says flexible installmental deferred. What's the deferred there? What is the deferred part?
Deferred is telling you that you can pay it as when you are available or when you have it. Yeah.
But the question is,
remember, there's one thing you should know in annuity.
The question is no less than 200 quarterly.
So that tells you it's not fixed.
It's not fixed. So
yeah,
well, that's why quarterly flexible.
That is where the flexibility in payment is.
Yeah, but when you said deferred, what is the deferred? I'm trying to understand what's the
deferred
deferred
is
part.
at any time when you have it, when you feel that you have it. Remember, in annuity,
but it says no less than 250 quarterly, no less quarterly. That means quarterly can be 200, but it's no less than 250 quarterly. Anyway,
Some of these questions are not straightforward.
Yeah, it's all right. I understand. I'm just
there's one thing you should know in annuity, in this insurance classes, insurance exam, do not put meaning.
Yeah.
You bring your own meaning to it.
Yeah.
Otherwise, it's going to be a problem.
Yeah, I understand.
But again, what you should know, the driving force for you to know is in life insurance, there is nothing like as it will be in life. In annuity, there's not like as it is in life insurance, whereby if you did not pay, they give you
Grace period.
Grace period. It's not like that in annuity. Nobody come to your house to ask you, please pay. No, nobody disturb you. Nobody call you to pay. Just like if you go to withdraw money from your cash value, nobody comes to you to say pay. No. So in annuity, nobody comes to you to pay your premium. No, nobody calls you. So
you deal with whatever.
because it's your investment. It's your
Your
investment.
boss.
They don't care. It's your investment. All right. So variable annuity may invest premium in each of the following, except variable annuity may invest premium in each of the following, except.
What is junk bond?
Yeah, it's government.
I don't know. Just right away, I say junk bond. I don't know what.
I think it's I think it's government. The government bond is called junk. I think so.
Oh, really?
Market.
Yeah, I haven't.
I'm just gonna take junk bond and keep going.
Junk bond is good. Variable annuities may invest premiums into the full except money market securities. Variable money market.
Any other person?
C.
Insurance company.
Somebody say C.
Yeah.
All right, 2 persons say C.
I would go with that.
You see, I want this. Everybody can discuss it and bring out the answer. I think that would be good. Because then there is a reason for answering, not just answering.
Insurance corporate business account.
So this one said W is 39
Oh, he
years
said
old.
except.
It's because of the
okay.
word except. So W is a 39-year-old female who just purchased an annuity to provide income for life starting at age 60. All of this would be acceptable annuity choices, except what?
Immediate, straight life, flexible, premium deferred, variable annuity.
D as in dog.
Yeah, D as in dog.
Why?
D as in dog. Any other person?
You women,
said D as in dog.
You women, how you women know how to manage money so much?
Chinyere said D as in dog. Somebody else said D.
All right, so the 2 persons said D.
Oh,
so
shoot.
it's immediate annuity.
I said
except,
A.
Hold on.
I said A.
Did you guys look at this? Except.
Oh, except.
Immediate, because it's at age 60, so it can be immediate. Yeah, I said A. But you women are good at managing money, so I left you guys.
Did you guys look at the word except?
Yeah.
Except.
Yeah.
So everything there is correct except.
Yeah, starting at age 60, so it can be immediate.
Yeah, we missed that.
Okay.
Yeah.
Right. Which of these statements?
You ladies are good. You're good at investments. You're doing good.
So which of these statements concerning an individual's straight life annuity is correct?
The payment I receive tax-free, be available to employ. Payment are made to an annuitant for life. Life expectancy of the annuitant is not a factor. Payment are.
I would say C.
That's
B for cat.
C. Straight life.
Anybody say what?
C.
Any other person supporting C?
It will be between C and D, so I say C.
All right, 2 persons say C. Payment are made to an annuitant for life. K is an annuitant currently receiving payment. If she were to die before receiving payment equal to the current value, a beneficiary will continue receiving payment until an amount equal to the contract value has been paid. This is called what?
Joint refund annuity, joint refund annuity, installment refund annuity.
That equal. Set refund, joint refund.
K is annuity receiving.
Oh my God. Hold on, listen. Currently receiving if
I would say D.
Receiving to the correct value.
I would say D.
D.
All right, 2 persons said D.
Yeah, that's what I say. I may be wrong.
Installment refund annuity.
Oh God, I should have said it out loud.
Okay.
This annuity is too much.
We didn't do good on this. What is the basic function of annuity? What is the basic function of annuity?
Okay, the protection against loss of income due to partial or total disability and systemic liquidation of accumulated fund. Yes.
C.
I would say C.
Yeah.
All right, C. Everybody says C.
Yeah, C for cat.
Systematic liquidation of accumulated funds, of course. All right, I think that's it.
We failed?
Huh?
We failed this?
We failed.
It's 6/3. It's not high enough to pass.
We failed. Now we have to get.
Okay, let's go back. Let's go back to another part of it.
So tomorrow morning we're gonna continue from chapter 10, which is use of life insurance. Plus, just try and be there. Like use of life insurance is one of the important chapters you need to know. You want to know why you are buying life insurance. You want to know. So, however, if anybody is going for exam waiting and he has any of the chapter that he found difficult, he can let us know so we can go through it. Go through the chapter so that he can have a good he or she can have a good understanding on that particular chapter. That will help the person to go and pass. The aim of all this the review class is to help people pass the exam, nothing more than that. So if you're going for the exam, there's a chapter that you think that you do not understand. Let us know. We're gonna leave everything to go to that chapter and get it done for you before you go for your exam. All right. Okay. So outside that, I think tomorrow morning we're gonna start from chapter 10, uses of life insurance. So there's a lot of things to discuss on uses of life insurance, a whole lot of things. So we want to know the plans behind life insurance, human life value approach and other approaches. We're gonna look at it to know what you want. Remember, I said when you are buying life insurance or buying annuity, you're gonna tailor it based on your family and your personal needs. You don't just go and buy policy because you have the money to buy policy. No, buy policy because you have a need for it. When you have a need for policy, that is when you know the importance. That is the basic truth. So your policy buying in terms of purchasing annuity or life insurance policy will be based on what you want. So we're gonna see tomorrow at all the things you need to do.
Okay. Thank you.
All right.
Yeah, so
thank you, sir.
See you guys tomorrow morning.
Okay. Thank you.
Yeah, thank you. Good night.
Thank you very much. But you will see me, I'll be at work.
Right. So